market, and the company is set to acquire UK-based Practice Plus Group hospitals for close to £190 million. Earlier, Vinny caught up with Sandhya J, the group CFO of the company, to understand more about this deal. She began by asking her about the company's international expansion plans. Listen in.
As you are aware, if you've been following us for some time, Cayman's been operational for more than a decade now. And after the initial period, which we had to overcome, we've been performing quite well in Cayman. And we've always been on the lookout for the next international opportunity. So what made UK attractive for us? Of course, apart from the obvious, which is that it's a developed country, there is a clear rule of law, business certainty, transparency, policy certainty, all that. What we saw was that within the industry, there has been meaningful success for large operators. And so we thought that this is a market where we could participate. For us, as we see Practice Plus, it's in our sweet spot. It's neither too large that it becomes unwieldy for us to integrate. At the same time, it's neither too small. So with the current size, we can be able to bring what value we have to offer, whether it's our technology, whether it is our capabilities. And at the same time, there is a lot of strength and execution, demonstrated execution from Practice Plus. So I think it comes together quite well for us.
Sandhya, what are the synergies then one will start seeing from this acquisition that you have made? When will we start seeing these synergies? And also, is this margin accretive for the company?
So tech is a big differentiator. We do believe that we will be able to improve the quality of care while being able to bring down the cost with the help of our technology. We also believe that there is a scope to increase work spectrum, but I think we will know that with time only. We have just got into the business. From a EPS point of view, this will not be EPS dilutive. Obviously, India and Cayman operate at a much higher margin profile than at which the target is coming and at which the market is. So if we look at from a group margin point of view, this will come in at a lower than the group level. But overall, I think jointly with the management of the PPG group, we will be able to demonstrate improvement in margins over time.
Okay, over a period of time, you will be able to see an improvement in margins. So then in the near term, maybe, till the integration process is over, we could see some bit of a margin pressure?
So if we look at each of these markets independently, I think we would be able to continue to build on and improve margins in India. Cayman, as we have always said, is a stable margin market. So therefore, I think Cayman will continue to perform the way it has been performing so far. And we are not going to be dilutive from where we are starting as far as PPG is concerned.
Okay.
So I think if we take the group numbers after PPG is integrated, I don't think we are going to have dilution pressure on the margins coming from PPG.
From here, there won't be any dilution, at least, is what you're saying. When will this full integration process be completed by? Will it be FY26? And you will start seeing those synergies in FY26 itself, or maybe can we expect in FY27?
So for a period of 6 months, there is the integration process which we will be going through, because we are only acquiring one portion of a larger group. There were 3 businesses in that group. We have only acquired the hospital portion. For the next 6 months, we will be working jointly with the sellers in terms of carving out the hospital portion and integrating it into the Narayana business. And I think the journey of Synergies is a long journey. It's not a point in time that it will be done now. So as we start, I think we will start looking at what are the opportunities. And I think it's a journey that we will have to walk on.
Mm-hmm. But when will that journey begin? 26 and 27 beginning?
Yes, we can say that, yes.
Okay. What about your profitability? Narayan's overall profitability, return on capital employed target after this acquisition?
because a lot of our assets were established a long time back. So therefore, they are very, very well sweated out. So Narayana has had the benefit of a very high ROCE for the past few years. But as Narayana, the India group goes into an expansion phase, we will see that getting stressed. And that's the cycle for any infrastructure-led business model where you have a capex cycle and ROCs are stressed, and then the assets start getting sweated out and the ROCs come back to normal. So while Narayana India goes through that journey of going through the asset investment cycle and then balancing and stabilizing the ROCE, we do believe that UK will catch up. And therefore, when we hit that FY30 kind of time frame, we do think that all assets may be equalized on ROCE.
Okay, that's great. And just the last word, any more plans, any newer acquisitions that you're looking at in any market, whether UK, Europe, anywhere?
So we've always indicated that we have interest in the international market. The threshold or bar for us is very, very high because as we know, our home market, India, is, if not the most, one of the leading healthcare markets in the world. And there is tremendous propensity for growth and for expansion within India. So if we are looking at a target outside India, it has to hit that very, very high bar to make economic sense better than India. So while we will continue to look out, I think it's a very difficult and long journey.
All right, with that, we'll do one thing. We'll slip into a short break. When we come back, we'll be joined by Karan Virwani, who's the CEO, India We Work, from the Global Leadership Summit.